All right. Good afternoon, traders. Again, some of you, I guess. If you were just at the live trading room, good afternoon again. Welcome back. If you are just joining us for the first time today, good afternoon and welcome out to the Trade Spoon Active Investor Workshop Series. For those who don't know me, my name is Scott Beck, and I am the head trading coach here at Trade Spoon. Hey again to you, Chet. Hello again to you, Phil. No problem. And hello, Dennis. Good to see you guys. Glad you can make it back. Those of you who weren't with me before, if you haven't prior, say hello, introduce yourself. We tend to see numbers drop during more volatile markets, which I always find interesting because I think this is exactly the time when we should be talking and processing it, planning, strategizing, et cetera, et cetera. So if you don't know me, my name is Scott Beck. I'm the head trading coach here at TradeSpoon. I have been trading for over 20 years. I have been teaching for going on 18 years. That's me. I need to remind you, and I'm gonna go through the full disclosures here. So bear with me, but I need to remind you that trading in options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. TradeSpoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team at TradeSpoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, TradeSpoon founder, is also an investor and a consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. TradeSpoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay. So we're still running on the same pandemic / post-pandemic active investor workshop where we go on the fly. We tailor the presentation to market conditions. We cannot be constrained by the parameters of slides. We have got to be free to explore wherever we need to go. And there it is. If I understand correctly, here's a comment. If I understand correctly, when someone buys a call, the market making firm buys shares of that same underlying in order to neutralize their book. What happens when a person buys a put? What does the market making firm do to neutralize that long put? Okay, no. I mean, in a general sense, they do want balance, but and any market makers, who do make the market on for options will typically carry an inventory, right? They'll typically carry an inventory, and so, but their primary, and this is a good discussion to have. So thank you, Ed, for the question. Their primary objective is to not be like a bookie. Think of it like a bookie, right? The bookie doesn't care who wins as long as they're a good bookie. They adjust the odds in order to get the bet so that if A beats B, then all the losers from B play the winners from A, and vice versa. And then they just keep the juice, right? The juice, the little bit in the middle. Well, that's the spread between bid and ask. That's the juice. The market maker's the bookie. It's the same thing. So as people are buying and selling options, they're raising and lowering prices of the options via implied volatility. Remember that implied volatility only has an impact on time value. Implied volatility doesn't have any impact or bearing on intrinsic value. That's just the relationship between the price of the stock and the strike price of the option. It's the time value that's going to inflate and deflate, right? And create what we would consider to be expensive or cheap. Some people say overvalued or undervalued. I'm a little bit of a stickler. I believe that options are always perfectly valued. Because when you talk about value, you talk about worth. What is something worth? It's worth what somebody's willing to pay for it. Nothing more, nothing less. Now, is it cheap or expensive? Well, that's a relative. In order for me to say that's cheap, I would have to know how much has it sold for in the past. If it has a range of $3 to $6, it's cheap down at three and a half. It's expensive at 5.5 or 6. Why is that important to us? Because that's going to help us to determine, are we going to be option buyers or are we going to be option sellers? Because today's presentation, if you remember, is bear call spreads. What is a bear call spread? It is from the family of vertical spreads. I know this one is confusing, especially if you're new. It confused the hell out of me. I remember when I was studying for the Series 7 derivatives portion, right? And you're trying to like what, bear call, bull call, bear put, blah, blah, credit, debit, vertical. And there's all these different terms. And you're like, well, which one is it? Well, I mean, a vertical is the whole family. In the vertical family, you have two styles, credit and debit. And within credit and debit, you have two types, a call spread and a put spread. So I have I can distinguish spreads by either being bullish or bearish or by being credit or debit, but not both. So if I'm thinking about credit spreads, I have a bear call spread. Obviously, it's for when I think things are going down. Bear call spread. So the first thing I want you to recognize with today's strategy focusing on bear call spreads, this is bearish. Can it survive neutral? Yes. It can survive neutral. It can survive sideways if you build the spread the right way. But it's bearish. You think it's going down, period. Whether it's the market or an individual stock, you think it's going down, and it is a credit strategy. Its sister credit strategy is a bull put spread, right? So I have a credit strategy that is bullish and a credit strategy that is bearish. We are focusing on the bearish strategy. And it is a credit strategy, which means you are a seller. You are a seller of time, essentially. Now, can you sell intrinsic value? Yes. Do I recommend it? No. Is it somewhat annoying to ask and answer your own questions in a presentation? Probably. But I did it anyways, because I'm brave like that. No, it is, right? So can you sell intrinsic value and get a bigger credit? Yeah, but you're not really selling something that's going to decay. You're selling something that has to move a certain way. When something has to happen, it has to drop or it has to go up. If something has to happen, your probability is diminished, right? Now, when we describe something like a bear call spread, we want to describe it with all it has to do is, not it has to. It has to drop from 100 to 90. Or all it has to do is not go above 105. All it has to do is not go above 100. If it's at 100 now, obviously 105 is the highest probability. It could go 4% wrong and still be right. 100 is less probability, but okay. All it has to do is stay where it is or go lower. 50-50 chance. So if I have a pretty good credit, maybe that's a good trade. But if it has to drop to 90, that's a little bit tougher. So that thought process of what does the trade need to do for me to be successful, that's actually going to lead us into how we pick strikes. and expirations, because that's obviously a big part of this. Let me just, I mean, I'll have people start saying your slides haven't moved. Yeah, because we're just talking for now. We're just getting the foundation in place for what a bear call spread is. I'm going to use GME. Now, somebody asked me to maybe use a different stock too. If you want me to use a different stock, I need you to suggest it. Actually, that's not true. I'm going to run a bearish search real quickly here. You know what? Give me just 1 minute. That's not what I want. Talk amongst yourselves in the meantime. I realize you can't. Ed said, I believe that the higher credit is what entices individuals unfamiliar with how options work to sell intrinsic value. Absolutely, right? Oh, I get a big credit. You're right. Right? Big credits can also come from extreme implied volatility, which same thing, right? Like, yeah, okay, you got a good premium, but you got a good premium because something crazy is probably going to happen. and they're pricing it in. I'm going to run a quick bearish search here on this FinViz. Over 2 million shares, over $10 a share. I want it to be up for the week, but down for the month. I want it to be, where am I at? 243. Let's get things, yeah, let's get it below its 200 day, maybe 190, below the 50 maybe. That didn't really help much, but okay. Now, what have our worst performing sectors been? They've been technology and financials. Right? So if you're looking at this thinking this market's going to roll over, if you think this market's going to fall to the downside, you want to trade the things that are already falling to the downside. Ed said Etsy, that might be a good one. It's a retailer type stock. Things like this, things that are already dropping: AEO, American Eagle, retail, ASO, Academy Sports and Outdoors. Now you'll notice that it drops, it goes down, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. What's next? Lower low, right? I don't like them if they're way down here. I want to see that they've come up a little bit. If you're bullish and you buy the dip, when you're bearish, you fade the rally, you sell the rally. Is there a screen? Carmen, yes, you should be seeing. I hope you guys are seeing. Is everybody seeing a FinViz with a series of thumbnail charts with some bearish looking stocks? If not, man, I have been just yapping. I've been yapping to a blue screen. Oh, okay. You know what, Carmen? I'm getting yeses from everybody else. Dennis, Blaine, yes, yes, yes. Got it. So look around. Try to see if you can pop up a WebEx, not WebEx. What am I on? Go to webinar, Zoom, some webinar platform. See if you can pop it up. If not, you might want to just pop out and log back in real quick. Because yes, there is a screen and I definitely want you to see it. So this is the first criteria for a bear call spread. What do you need to be? Well, you better be bearish. That makes sense for bearish trades. Be bearish. You think something is going to drop. I think the market is going to drop. I think this stock is going to drop. You are coming in as a seller. So when you are a seller, what do we prefer? We prefer to sell things that are more expensive. Expensive and cheap is expressed with options through implied volatility. High implied volatility, expensive. I'm more inclined to come in as a seller. Low volatility, options are cheap. I'm definitely more inclined to come in as a buyer. So keep in mind, as we look at this strategy from a Greek perspective, it is a delta negative strategy. Delta negative means you make money as the stock goes down. You lose money as the stock goes up. Delta negative. Can we make money sideways? Yes. Even though it's delta negative, if it doesn't go against us, this strategy is also theta positive. Theta being, how does our trade respond to time? Well, if we're theta positive, that means we respond positively. As time ticks, we make money. So sideways is good. It's not as good as down, but it's okay because even though the stock's not going for us, time is working for us. That's what lends itself to the probability factor in this trade, right? We said that having if I buy a put at 100, it has to drop to 90. If I sell a bear call spread at 100 to 105, all it has to do is stay below 100. That's it. Stay below 100. So what am I doing with a bear call spread? With any vertical spread, you're buying one, you're selling one. Same strike, same stock, same expiration, different strikes. Buy one, sell one. Buy the 100, sell the 105. That would be in this case, if it was calls, that would be a bull call spread. Buy the 100, sell the 105. The driver in any credit spread is the contract that you sell, the short leg of the spread. We have a long leg and a short leg. The short leg is the one you sell. That's the one you think the stock is going to stay below. So if I were to, this ASO is interesting to me. Actually, it's a little less interesting now because that chart was a little more misleading. I look at this and I think, you know what? I feel like it's actually broken out. And this is where you have to be careful with long-term downtrends. Eventually, these things are going to stabilize. It's going to break out. It's going to come back, and then it's going to give me a higher low, and then I think become bullish. And I think that's a little bit where we are right now. That's it, Ed. The theme song for theta positive strategies. The Rolling Stones. Time is on our side. Yes, it is. Right? Okay. Let me go back to the drawing board. Let me find one not. What about APTV? Auto parts out of Ireland. Top of the morning to you. What was it? APT? APV? APV. That's not it. APTV? APTV. Come on, Scott. Get it together. APTV. All right, that's a little better. So it doesn't really have that volume or that big spike. Yeah, it looks like we have something that's just kind of grinding along at resistance. Okay, so that's another key point. What would I like to have? I'd like to have sideways at best, downward preferred, or sideways at worst, downward preferred in regards to the trend. I want to know that the sellers are in control of something. If I'm gonna build a bearish trade. Now, the next factor that I look at in terms of building a trade is support and resistance. Are we at or closer to support, or at or closer to resistance? Well, if I think it's going to go up, I want to be closer to support. So I like to put bullish trades on at support levels, bouncing higher. If I'm bearish, I think it's going to go down. I want to get in at resistance. You fade the rally. It rallies, doesn't do much, and then it starts to drop and go down from there. So when you think about any trade like this, you want to think, what's the setup, right? Setup is a bearish stock. The setup is at or near resistance. I would like to have something that trades at least a couple million shares a day. I want high liquidity. I do not want to trade. If you've ever bought options on a low liquidity optionable stock, right? You're going to find pretty wide bid asks. When you spread trade, it's doubling it, right? You can sometimes get away with a lack of liquidity as a buyer. You might be able to split the difference when you get in the trade. Just recognize that there's likely to be some issues getting out. But when it comes to spread trading, you really lose a lot of your ability. So make sure you have high liquidity. I mean, God, to be honest with you, if you trade options, I would prefer to see you become just a straight up absolute option snob. Snob it up, man. If it doesn't trade a few million shares, if it doesn't have hundreds to thousands, right, of contracts in open interest, it's not good enough. Get rid of it, right? Sometimes you'll see dozens to hundreds, and you'll think, well, maybe. I mean, can you make money with it? Sure. Is it incrementally harder because you're going to have much more spread to overcome, and because the worst case scenario in that situation is when you're struggling to get out because it's going against you, then you really see that nastiness of low liquidity and you can't get out, and by the time you do, your losses, much bigger than you had anticipated it might get to. So I know some of you have probably experienced that before, and you're shaking your head like, yeah. Open interest is the key. How many options are good? Like hundreds. What is numbers? I mean, like I said, hundreds to thousands would mean that around the round numbers, 85, 90, 95, you'll probably see thousands. Around the odd numbers, 81, 82, 83, 84, right? 86, 87, 88, 89, those might drop to the hundreds. That's where I'm like, okay. As a general rule of thumb, I want my bid-ask spread to be no more than 10% of the cost of the option, which is the ask. If I had my absolute druthers, and this is why I trade some of the large ETFs like SPY so frequently, and maybe we'll look at SPY for a bear call spread too, but thousands, tens of thousands, and the spreads are pennies, and it's just like a beautiful oasis of options goodness. Every trader is a little different. I mean, I've seen times where they don't have weekly options, but I was like, wow, they have really quite a lot of liquidity, and I traded it no problem. Then I've seen times where they have weekly options, and I'm like, oh my God, these are garbage options. There's nothing here. How do they even have weeklies? But they do. And I wouldn't touch them with somebody else's 10-foot pole. Right? So, that's just something to take into consideration for sure. By putting 2 million shares on our search, we did a pretty good job of accounting for that, but I still like to look at it. Okay, so let's say this is our example. We're now convinced this is hitting resistance. We think it's going to bounce. What's the first thing I need to do? Well, I need to start thinking about, number one, time. Time. When this thing drops, how long does it drop for? Well, you can see there was a drop, and there was a drop. Both pretty big, both pretty far. They took, I don't know, what would that be? The 7th until the 30th, but 3 weeks, right? 3 weeks. Right now it's March 15th. I've got the March is expiring on the 15th, on the 17th, 18th. Next week it looks like the options would be to the 15th, so maybe I go April 15th, and now I've established what? My expiration. So that's the first thing. When you're thinking I want to do a spread, okay, for how long? For how long do you need that spread? What do you need for that spread to achieve its objective for you? If you're questioning it at all, here's something to think about. Shorter time frame. So if I sell April, it's going to have a faster theta than May, meaning it decays faster per day than May. But my ability to control my risk would be dramatically higher with the Mays. If it goes against me early, I'm not going to lose as much with the May options as I am with the April options, because the extra time builds a bit of a time cushion into the mix. So there you go. Something to think about. Gamma. So gamma, you'll notice I haven't really talked about gamma with this strategy. And one of the reasons why is because ideally I'm not in this trade the last week. And that's when gamma risk really kicks into gear. So we've talked about delta, which way do we want it to move and which way does it, from a directional standpoint, do we profit or lose? We talked about theta, how does time work? If you buy an option, you're theta negative. If you sell a spread the right way, not all of them. Some people think, oh, you sell your time. It's not always true. Don't just make that assumption. If you sell an at or out of the money credit spread, theta positive. What is your Vega? Well, first and foremost, what is Vega other than super awesome car? The Vega is how does an option behave relative to changes in implied volatility? Now, what did we say? We said we want implied volatility up high with the expectation that it either stays high or drops. Stays high or drops. Dropping volatility. What makes money with dropping volatility? Negative Vega. Negative Vega. If you have a negative Vega trade and volatility drops, it increases the rate of your profit. What are negative Vega trades? Sell a naked put. Sell a put spread. Sell a bear call spread or a bull put spread. Sell an iron condor, which is both of those things. You get the drift that there's a selling component to get that. However, there is a strategy known as a butterfly. That's a debit. You buy it, but you do end up negative Vega. Negative Vega means I want implied volatility to drop. If I want it to drop, that stands to reason. I would want it to start high. If the implied volatility is low, you don't think, oh, that low volatility is going to just keep dropping. You think, hey, that's low volatility. That's pretty cheap. Pretty cheap means be a buyer. Be a buyer means Vega positive. You didn't know that this bear call spread presentation was going to turn into a presentation on the option Greeks. But that is what makes this such a wonderful webinar, because we will go whatever direction we need to go. It's beautiful. And this is the right discussion. If you're going to be an options trader, you learn to speak Greek. And when I mean Greek, I mean delta, theta, vega, gamma. Gamma is how sensitive is deltas to changes in stock price. Deltas don't stay the same, right? As the stock goes up or down, your delta will increase or decrease. Gamma tells you by how much, how fast, right? Delta is the velocity. Gamma is the acceleration. So delta tells you how fast is it already going. Gamma tells you how much will it accelerate or decelerate if things start to change. Now, gamma risk occurs, the less time you have, the more gamma risk you have. So if you have a lot of time, you don't have a lot of gamma risk. As you get to the end of an option, especially a spread, when you get to the last week or two, as you have less time, what happens? Gamma risk starts to increase. So there you go. Okay, so now what? We have a bearish stock at resistance that we think looks like there's a chance it rolls over. This is not, please remember, this is not a recommendation to build a bear trade. This is not to say that I even think this is going to drop from here. Actually, as I look at it, I think it could make a run higher still. What I'm saying is it looks like it's starting to find some resistance. That's where I would start to look for something to roll over. We've already said that we think April's probably good enough. That puts us out here at the edge somewhere to possibly catch this next drop down. Maybe not quite that pronounced, but okay. Now, what's next? The next thing I have to do is I have to determine what contract do I sell. Remember, that's the driver, the short leg. What do I sell? All right, well, this is how we decide. Where do you think it's going to stay below? And if you said, oh, I definitely think it's going to stay below 140, I'd be like, yeah, me too. But that's pretty far out of the money, so you're probably not going to get paid very much. That would be what we call a high probability. If I sell a 140 and buy a 145, that is a deep out of the money bear call spread. That is a high degree of success. That is a small credit with a lot of risk. The smaller the credit, the more the risk. So if I did 140 by 145 and I got 50 cents of credit for it on a $5 wide spread, 50 out of 5, that means that I'm risking 450. So if 8 times in a row it doesn't go there, but on the 9th time, it all of a sudden smashes through, I'm at a small loss, even though I was right 8 out of 9 times. If you're wondering if I'm a little reluctant for high probability spreads, just set it and forget it. It's the Ronco credit spread. Set it and forget it. Out of the money, blah, blah, little credit. Be careful. Be careful. I'm going to be much more aggressive. I'm directional. This is delta negative. I'm directional. I think this is going to drop. I'm wrong if it breaks here. So I might have a stop loss here. So I'm probably going to, let me change my color. I'm going to sell it maybe here and buy an option up here. I know those lines look terrible, but that little road with the green outer edge and the dotted middle, the first green is my short. That's maybe around 110. And then this one is maybe around 120. You're like 10 points wide. Are you crazy? No, it's fine. You'll see. With a stop around 100 and 112, maybe something like that. Okay, so let's go build that trade so you can see what it looks like. Let me come in here to APTV. Can you believe I remembered that? It's pretty good. Pretty good. And we are here in vertical spreads. Now, let me show you some things. Volume and open interest. I don't have weeklies, so I'm already a little suspect of it, right? No weeklies. I do have thousands here at the money at the 110, hundreds a little bit around it, but this is definitely questionable. Questionable enough that with the spread, I probably wouldn't do it. But since we're already here and we don't have a lot of time, I am going to do it. But you'll notice that the spread is in the range of like, okay, it doesn't violate my worst rule of 10%. $6.30 option, it needs to be less than 60 cents. It's 40. This one does though. 440 by 390. That's a 50-cent wide on a 440. That one's more like 12%. So these are definitely a little bit iffy, and that alone would most likely preclude me from building this type of spread on this stock. However, we're going to go forward anyways. I'm going to do the 110 by 120. We'll just say. And that trade looks like this. Now, remember, I said I'm going to stop out maybe around here, 112.50 or so, right? Something like that. So if I have a stop loss at 112.50, now my target to the downside, you'll notice my stop, I'm only risking about $990 over here. I'm not risking all the way down here because I'm going to exit the trade if it goes against me. That is very important because if you put a trade like this on and it goes against you and you get stuck like a deer in the headlights, it's going to have the same results for the deer in the headlights. It's going to hurt, right? If you were to ride this out, there's a lot of risk out here. In fact, if you ever use these risk profiles, I am very reluctant to let it get to the wrong side of this. Very reluctant. However, as it stands, That's about $1,000 of risk. So I'm going to say I'm willing to risk $500 in a trade. So I'm going to bring that back down to 5 contracts. At 5 contracts, I'm risking about $500 in this trade. What does it have to do? It has to not go up more than 2%. I'm good. Max gain at 110 and below. Maximum gain. I make money from time anywhere below about 115. Over here, things are dropping. Here, things are rising, meaning time. So my objective is that this trade always stays below this green zone here. And you can see my stop. We said my stop was at right this line, which that's where the $500 of risk is at. To make what? Well, if I made maximum gain, I'm making 1775. That's better than 3-to-1. But I don't think I'm going to make maximum gain. In fact, my objective would be, whoops, I don't want the calendar. I want the calculator. 1775 times 0.8, 1420. Where do I make 1420? Well, in the beginning, I make it right around here, around 91. So let's move this to 91. Is 91 in the cards? Now that's if it drops in one day. If I think this trade's going to take 2 weeks, I can take this trade out. What day is today? The 15th. Take it out to the 29th. And on the 29th, I make 1420 at 96. So the longer I'm in the trade, the easier it is for me to get. If I'm in another week after that, I make 1420 at 100. So right now it's at 91. In 2 weeks, it's at 96. In 3 weeks, it's at 100. So we start to think about that. Well, 100's only right here. If 3 weeks from now, if we're out here around this period of time and it's mostly gone sideways, I'll have made 80%. 80%. And this thing didn't do anything. That's if it goes sideways. If it drops a little bit down here to 96, just these old lows, in 2 weeks, I get 90%. That's right here. 2 weeks out, $96 drop right there. I get 90% or 80%. Or if it drops to 91 right away, 91 is down here. I mean, none of these are that big of drops compared to what we've seen this thing do, right? So we ask ourselves, is this reasonable? Is this a reasonable trade? Do I have a reasonable chance of making 80% on this trade? I'm going to have to say, yeah. I think that the target of 91 to 100 over the next 2 to 3 weeks, very much reasonable. And that produces us should be a $1,400 or $1,500 gain. $1,400 or $1,500 gain for what? For now, again, let's go back. You'll notice it's $500, but if I'm in this trade for 1 week, let's go to the 22nd. Well, now it's not 5, it's only 466. And if I go another week forward, now it's only 400. So the longer I'm in the trade, the more I make if I'm right, the less I lose if I'm wrong because of time decay. Remember what we said about our Greeks. Here's our delta. Our delta is negative. We want it to drop. Here's our theta. Our theta is positive. We make money from time. Here is our vega. What do we want it to do? It's vega negative, so we want volatility to drop. Okay, so if you're bearish with high volatility, what's a great trade to put on? Bear call spread. Bear call spread. You'll notice this is a trade that gets me, you're confused why 3-to-1. Okay, let me Let me show you again. Remember, this 3-to-1 concept is based on a line in the sand at 112.50. That's where we're wrong. That's how much we're going to lose or less. We're figuring this from today. The most I would lose 500, right? So my risk is 5, my gain 14. So 2.8 to 1. Yes, because theoretically, does this trade have a larger max risk? Yes, it does. Clearly it does. Maximum risk on this trade is like 3,200. Well, maximum risk on buying a stock is the whole cost of the stock, but we don't really figure, well, that's what's at risk, right? Because we're going to be, and I say this because I want, right, everyone to recognize we're going to be very diligent so that if it crosses our line in the sand, in fact, I might even put a hard stop that says if stock APTV, now I wouldn't on this one because it's low liquidity, but beautiful, love it. Thank you, Sarah. I appreciate the question. Great question. That whole concept of reward to risk can be hard, right? But if we're specific with how we design trades, then I want you to quantify your reward to risk from your trade design. Where's your line in the sand? How much are you going to lose if it gets there? Because that's how you're going to determine your position size. Somebody else might say, Scott, I like this trade, but I'm not willing to risk 500. Great. Reduce your number of contracts. You're risking 100 a contract basically with this. And then you're getting almost 3 times that if it does what we think, which is drop somewhere between 91 and 100 over the next 2 or 3 weeks. If it goes further and faster than that, great. I'll pick up my when it gets to 14, I'm done. Right? It gets to 14, I'll be like, I got my 2.8, I booked it, I'm out, I'm on my way. Now I could definitely do a high probability spread, which would be sell the 140, we said, right? Sell the 140, buy the 145. And what happens? Well, you'll notice this is where it is now. It's not even, I wasn't even close, 50 cents. You got to be out of your mind, 20 cents. So what do I have? I'm risking, 2,400 to make, what do we have here? $100, $100. Is there a good chance it stays down there? Yeah, but does that make sense? I am not a fan. I am not a fan of what people call high probability credit spreads. And such a enticing name, high probability. Ooh, you're right so much. Yeah, but you could be right 8 in a row and the 9th trade will wipe you out. I've seen it. I've coached through it. Oh, this guy's been right 29 times in a row, 30 in a row. And then all of a sudden on 31, it blows up magnificently. And it's like, oh gosh. Anyways, so my preferred mechanism is to sell at or slightly out of the money. Like we did here. The stock's at 98 and we sold, or no, the stock is at 108 and we sold a 110, a slightly out of the money. If you want to go a little further out of the money, you could, just to give it a little more room. But remember that the further out of the money you go, the less the credit you're going to receive. So that is that's the gist of it here. Then we manage the trade, right? We manage for time. We don't really have to adjust. When I buy options, you'll notice that I'll move stops because I need to take risk out of the trade because time's working against me, and it's just a more it requires a more active management strategy. But this one, risk is coming out of the trade organically from theta. So do I need to like tighten a stop and then make a daily adjustment? No, I might make 1 or 2 adjustments and that's about it. Right, step 1. Context. Is it bearish? Is it at or near resistance? Do you think it's going down? Step 2, what expiration do you need? How much time for this trade to drop? Shorter, decays faster. Longer, allows you to control your risk better. You know, find your Goldilocks sweet spot somewhere on that scale. Next step, what are the strike prices? Start with the short. What do you think it's going to stay below or get below? If you sell something that's just a little bit in the money because you think it's going to drop, okay, little in the money, still mostly time. Don't sell intrinsic value, right? Don't sell intrinsic value. That doesn't have any benefit to it. There's no benefit whatsoever. So step 4 is set your short strike. Step 5, your long strike. That's going to determine the amount of margin, the credit. You can then quantify based on your stop loss how much you're going to lose. That will help you to position size the trade. You can find out where 80% is, so you know what your target is. You know your target is moving due to time, and that the longer it takes to get to your target, the easier the target becomes. The target comes closer to you the longer you're in the trade. We want to, if possible, still maintain a favorable reward to risk ratio, and that's the T, and that is bear call spreads. Bull call spreads or bull put spreads, exact opposite. So if and when we start to come out of this market, we're going to come out of a volatility in the 30s, and hopefully that comes from 30s back to 15. That is a bleeding implied volatility environment. You don't want to buy calls, which are vega positive, when volatility is bleeding. You want to sell puts or sell put spreads. So right now in this elevated implied volatility environment, credit spreads make a lot of sense. Makes a lot of sense, right? Okay. Whew. Good one today. I've got a few minutes. And I didn't even go look at GameStop. I think someone, was it Dennis? Dennis like, don't do that garbage stock. Yeah, but garbage stocks can fall and they have high volatility. Let me show you. Maybe we'll look at the difference. Let me know if you have a question. I'm going to go ahead and show a couple of charts just so you can see. So here's APTV. Actually, look at the vol on this one. It's off the charts. It's high, 60%. These options are 50% more expensive than they were 3 weeks ago. So there's a lot more volatility here. So if you're like, oh, I'm going to buy a put, then you're going to buy an expensive put. You are. And if the market turns around and that volatility drops because the market starts going bullish, that expensive put's going to hurt. But that bear call spread is going to hold up a lot better. Buying puts, my friends, is for early. Buying puts is for early and still a little bit early into a downward move. But if it's already been down there, you're going to find that the vast majority of the time we're up here. It's expensive. Be careful with it. Now, if I go look at GME, GameStop doesn't have really much of a bearish swing up right now, however. Even here, now what would I want to see? Well, I'd want to see this thing pop up, maybe get back up, start to roll over, right? Like this. I want to see this come up and then give me another one of these where it rolls. Then what? Bearish. Look at the vol on this thing is 150%. It's off the charts. And it's about as high as it gets, right? So that's what we mean. When the market recovers and the vol is all back down here towards the bottom of the chart, great, buy some options. Take a swing for the fences. But like this, I want time on my side. It adds an element of probability. Okay, well, no questions. You guys know what that means. It means that you are mesmerized by the quality of the presentation and the charm of the instructor. Cecil has a question. Would doing a long call diagonal be a bad strategy? Yeah. So diagonals, calendars, long options, all vega positive. So vega positive, and it's going to hurt more, right? Rather than If you're thinking about a diagonal spread, which is kind of a bullish with some neutral components, you might do a broken wing butterfly instead. A broken wing butterfly will give you some neutral and some bullish, but it will do it with a negative vega. Still positive theta, still time decay on your side. But you need but you want that vega on your side too, that volatility, and it just wouldn't be. Or we need to hear this over and over until it seeps in the brain. Study and memorize the Greeks. Carmen, you are not wrong. That is absolutely, I mean, it's a lot, I know. And I can remember presentations when I would hear people delta positive and this is negative, and I was like, my head was spinning, like, what the hell are you talking about? And now that's the only way that I want to talk, because you realize, okay, you know what? Price, time, and volatility are the three main components, the three main variables that go into option pricing. So for options to go up or down, which is what we're looking for, if we sell them, we want them to go down. If we buy them, we want to go up. There's a lot more than price that goes into that matrix, and we need to understand all the variables. So yes, listen to it again if you can stand to my bad jokes and all. And maybe even go back in time in the archives of the active investor, because you'll find the Greeks. There's an entire presentation on the Greeks. Well, that's all I talk about: delta, theta, vega, gamma, rho, tomorrow, right? We don't talk about rho for so long because interest rates were nothing, but now RHO rho is how sensitive are the options to a change in interest rates. We haven't really had to do much with that, but interest, remember that this has to do with time. And in order for us to price time, then we have to know what is risk-free time worth. And for risk-free time, we look at the government bonds. As the interest rates go up, obviously government bonds will as well. Time becomes more expensive. Options become more expensive. I mean, it's not going to be like this, like, oh, they raised the rates and now options are 50% more expensive. It's much more subtle than that, but it's worth noting. So, all right. Well, thank you very much, everybody, for coming out, having a little discussion. Can I give an example of a broken wing butterfly versus a calendar? Oof. Unfortunately, Cecil, that one takes some time. But if you Google broken wing butterfly, you'll see it's just making it a little bit more bullish one way. And I think if you go into the archives, you'll find that there is a butterfly strategy not too long ago. And I think in that presentation, I actually break the wing and show what it looks like. But it's when you have a butterfly, you buy the wing, sell the guts, right? And usually they're equidistant. But if you buy closer, so if I go 80, buy the 80, sell the 90 times 2, buy the 100, to break the wing, I would buy the 95, which is closer, makes it easier to go up. Anyways, take a look at that. Where can we find the archives exactly? That I do have time to answer very quickly here. If you are in this quick navigation and you go to event recordings and you go into the active investor workshop series, you can see selecting strike width, protective puts, using leaps. I don't know what this one is. Fundamentals, options. And you can just kind of scroll through here and find some things. I believe, Sarah, I thought they sent one of these to you after it ends in processes. So maybe look in your email. I don't know. But if not, it'll be archived. Yeah. I'm glad you think it's good enough to go back to it. How about that? I appreciate that. I hope you guys have a wonderful rest of your day. If you're only coming for the active investors, I'll see you in 2 weeks. Someday, make a decision to join and jump in, because there's a lot more good stuff that we do, I think. If you're already a member and you're going to be in the trading rooms, I'll see you tomorrow afternoon. Trading room extravaganza should be fun. Bring your coffee, bring your smile, bring your good attitude. Enjoy the rest of your day, everybody. And as always, Happy trading.